Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 4th, 2018. I've had a few requests within the trading room for an update on the precious metals, gold and silver. And I know a lot of people like to trade the miners, myself included, when the time is right. My analysis hasn't changed recently, but then again, let me go over that for those of you that haven't seen my most recent post. Before we get into the charts of the metals and miners, and when we get there, I'm going to make a case that hinges almost exclusively on what the U.S. dollar does, and that's why I'm watching the Euro U.S. dollar pair, the Euro U.S. dollar index. We'll get to those charts in just a second, and I'll show you where what's been going on and where we're likely going and what to look for. Before we do, and this is somewhat related, despite we've seen some extreme volatility in the stock market. And despite that, there's been extreme low volatility in the currencies, the U.S. dollar and gold and everything else. And again, the one they go hand in hand. The low volatility in the U.S. dollar translates into low volatility in gold. So I'll get to those charts in a second. But on the flip side, we've seen that extreme volatility in the U.S. stock market. And here's a reply I made yesterday regarding that. I've talked about this quite a bit in the past. You've heard me refer to what's widely known as the short vol trade. That means short volatility, and that is you can do a Google search on it if you want to know how it worked, why it worked. It's basically institutions shorting volatility, and the stock market's coming off a period of unprecedented, never before seen, not even close. We've hit not only the longest extended period of low volatility in history, but also we hit lowest levels the VIX has ever seen in history. So extreme low volatility and for an extended period of time. In fact, here's a chart that I posted in there. Got this off the Wall Street Journal the other day. It said it's normal for equities to see a 3 to 5% pullback every 2 to 3 months. However, we just came off a 15-month uninterrupted rally without a single period where we had two pullbacks, any pullbacks of 3 to 5%. And so what this chart shows you is duration between 3+ % drawdowns in the S&P 500 since World War II. Average excluding the recessions, because during recessions, remember, you're going to have more volatility. The markets tend to fall. You're going to have more down days. Um, um, so that was 48. However, even if you include all the days, the average is only 49. So typically, what this is saying, on average, since World War II, we've gone on average about 50 days, a little under 50 days, um, between days where the market was down 3% or more, and the median is over that period of time only 38. And again, we're just coming off now a period of was almost 300 days, 15 months. So again, it's never been seen in history, but that's gone now. That is gone for good. I've heard from other people, and I myself believe this. We'll probably never again see this in our lifetime, such an extended period of low volatility. So take it for what it's worth. And again, the point of this was, as I wrapped up in those comments, welcome to the new norm, or which is really the old norm, because we're back to where we were. This chart below shows the S&P 500 daily range. I'm using a 50-day moving average. And you can see back in 2013, 2014, here was the range right here. Basically, on average, the markets would go up or down about 1%, 3/4 or 2/3 of 1% to about 1% or so a day. That was the norm. We had some volatility in 2015, 2016 where it picked up. It abated at one point. And this, I promise you guys, this will abate. This is not, when I say the new norm, we're just back to where things are. We're out of this period, this extreme low volatility. It was great for buy and hold investors, but it had a lot of implications on the market, and those implications are unwinding now, and they will continue to unwind. And that's the massive trend towards indexing recently, and back to a stock pickers market, and we had very little sector rotation during this time as well. So there it is. Volatility has peaked up, has certainly picked up, as we know. If anybody listening to this video, you're following the financial markets or trading recently, and it will abate. That I promise, but it's sooner or later. It just, we're probably not going to go down to these levels anytime soon. So the takeaway for this, factor that into your trading. If you're trying to trade whatever it is, just say that's the SPY or QQQ, you're trying to trade the indexes, and you're swing trading, and you like to use tight stops, 1-2%. Well, my suggestion to you, I can't tell anybody what to do, is shut the computer off, find something else to do, because you're going to get your stops run on an almost daily basis. You're going to have one good day where the market's up 2-3%, but even during that day, you'll probably have a 1% pullback. So uh, the point is, you have to prepare, and one way to trade with that excessive volatility, if you do want to engage a market, you do see opportunities, but you don't want to allow, losses that exceed your risk parameters, take your position down. Don't trade if you're usually trading, whether it's 10,000, 100,000, 500,000, or $500, whatever your trade amount is. Cut it in half, cut it in two-thirds, whatever, reduce it down. So if you usually allow a 5% stop loss on a trade of $10,000, that's a 500% loss. Take a $5,000 position, and then you can allow a 10% loss, which is the same net dollar loss. That is what I do. That's that whole term beta adjusted position size I've always used, relative to each position's volatility, but that same concept applies to the broad market. So, okay, so again, a little bit off topic, but it does play into this, and we can segue now into the charts of the metals, in the miners. I'm going to start out with the euro US dollar pair, which is often my proxy for trading gold and silver and other dollar sensitive assets and commodities, oil being one of those. This is a chart I've shared for quite a while. We've had back here, we had a divergent high. It was pointed out at the time. Price targets were given in advance when we were well within the wedge. We hit that first target, then we went on to hit the top of the second target zone reverse. So the bigger picture now are these yellow lines. This is a bearish rising wedge pattern. We have, most importantly, more significant than the upper trend lines, in my opinion, is this uptrend line off the lows back in early 2017, and you can see a lot of reactions there. So the euro US dollar pair is flirting with that now. Why am I using euro US dollar? Well, the euro is the largest component of the US dollar index and has the biggest impact on it by far. It's over half the weighting of the US dollar index. And this chart, which I'll show you in a second, will determine where gold and silver are going. So I'm watching this one. Now, there's not a lot of clues. What I have drawn out here on this daily chart, and this is what I've highlighted before, this can break down at any point now. Once this breaks down, that is bearish for the euro, which means bullish for the dollar. So when this chart falls, the euro is falling against the dollar, so the dollar will rally. That's bearish for gold. So if that happens, you can see my first target. You would expect a pullback in gold as the euro falls and the dollar rallies. So one scenario, if it does break down soon, I would favor a bounce off this level here, about the 121 level, and maybe a kickback of the rally. Hard to see right now. Hard to tell you where it's going very near term, other than we are sitting on key trendline support. So that's my point. This can break any day. If it breaks, boom. And it breaks with conviction. I'm not talking limping through. Right now, we're hugging, the last couple of days, we've hugged that trend line. These purple lines show a potential scenario, and you can see how I've drawn these trend lines a little bit above where these indicators are down below, the PPO and the RSI down here. So what this would show is if we hold support now and we get another thrust up, and I'm slightly leaning towards that, but again, don't underestimate the fact that if this breaks, that's it. Support is support until unless broken. That's why I'm saying right now you don't want to step in here. You can certainly go long the euro if you wanted to because it's at support with a stop not too far below. But if we get this scenario, and I like this, and it could go all the way to the top of the wedge as well. But as long as we come back up now, what'll happen is we'll have another divergent high. Back at this point, there was a small one right here. That's where it says second divergent high was this point right here when we went down right there and there. That's what that is. So this would give us a bigger divergent high, set the stage for a breakdown of the wedge and a pretty big move down in the euro, which would be a pretty big rally in the US dollar, and that would give headwinds for gold. Why would it give headwinds for gold? Why am I so convinced? Where where this chart goes is going to tell us where the dollar goes. Let's just look at this. Here's a two charts side by side, same chart we were just looking at. I used a line chart here, going back to all the way back to mid 2015. And the correlation, and I've shown this many times over the years, the correlation is very tight between the two, meaning when the euro is falling or the dollar's rallying, I should say, think of this chart as the US dollar in reverse, okay? So when the dollar's rallying, gold is going down. When the dollar falls, gold goes up. So you can see there, it's very clear. And now you might look at this chart and say, well, Randy, they don't look identical. Don't look at, they're not one-to-one ratio. That's the thing, the euro, US dollar, and gold. So what you need to look at are the trends, and I can show you that another way. So here was a peak. Actually, just follow the crosshairs. When I put the crosshairs on here on gold, you can see back here, we had a peak right around that time. You can see the dotted line on the left on the euro, US dollar, or I can do it here. So you can see there, we started to fall right here. So the euro fell, meaning the dollar started to rally, and that is when gold fell shortly thereafter. You know, it's not, there's sometimes a lag time, a little disconnect. I've always said that with any correlation, you can have periods of temporary disconnects, but overall, the relationship is pretty good. Here was a, let's see, we back here, the euro peaked, so the dollar bottomed right there, and then shortly afterwards came a major top in gold with a big correction as the euro fell and the dollar rallied. So again, and you can replicate these charts on your own. So that's what I'm looking at, the bigger trends, and forget about any temporary disconnects. That's what we're looking at here. And you can even see here, there was that peak, there was a pullback, there was a pullback there, one last thrust up, and this brings us to where we are today. So now we're going to focus on this, and we'll wrap this up. This is why I haven't posted a lot of analysis on gold or silver, the miners. I'm doing it by request. This is also why, personally, I'm not trading those. We don't have those as trade ideas on the site. Let's go back to the chart we were on. All right, so there it is. And now we zoom down a little bit. Let's go down to, this is a 4-hour period chart. And this is what I've shown recently. This is, so we're zooming in a little bit shorter in time frame. Here's the euro US dollar pair in a tight sideways grind. It's in a trading range. So I've shaded this box right here. This is the trading range that we're in. There's the uppermost bound of that trading range and the bottom. Now, if we break down through the bottom of this trading range, we will have certainly broken down below that bearish rising wedge. But the takeaway from this, guys, is what I do, and the reason my analysis has been light on gold and the US dollar and silver is because in these sideways trading range, you're going nowhere. You're getting chopped to pieces. You can try to trade this, but again, the connection isn't so one-to-one. And when you get in any asset or security gets in a sideways trading range, what happens is the indicators, the momentum indicators down below start to flatten out. They give very little clues. I like to find things that indicate major moves or tops or bottoms or rallies in the market, such as bullish and bearish divergences. Those don't exist during sideways trading action. And to add to that, trend indicators will whip the hell out of you. You get whipsaw signals. They're not reliable during sideways trading ranges. So the takeaway from that is step aside and just wait for the next objective setup. There it is. Here's the chart of gold on a 4-hour. You can see that's not by coincidence. This is that same sideways trading range. Here, I'll show it to you boxed in. That's what we were looking at there on the euro US dollar, and you can see it is almost a perfect correlation lately with gold and the euro or the US dollar moving up and down, or at least in this sideways trading range. So that's it. So the long end of it is you have to break. Gold's going to need to break to the upside or the downside with the US dollar. I gave you my thoughts. Longer term, I'm actually bullish on the dollar. I know we got a lot going on right now, trade wars, everything else. But remember, the dollar the dollar index is just relative. It's the U.S. dollar compared to other currencies. So we might have some lousy fundamentals going on, at least in my opinion, by what I read. these huge tax cuts are going to create massive deficits in the U.S. We've got trade wars going on. But again, the charts are the charts, and I'll let that be my guide. So as soon as we get some developments here, anything actionable on gold or silver, I'll let you know. Same thing happens to the miners. I don't even need to put it up now, guys. I've done it so many times in the past. I'll just jump back to a daily chart in gold to show you this sideways grind. But the gold mining stocks will trade almost hand in hand with gold. Very few periods of disconnects. The miners are just a little more volatile. So I don't. That's my actual preferred trading proxy. If I can identify a trend in gold, and you can see here, this is how gold trades. There's rips and dips, and every now and then. Oh, sorry, hit the pause button there. Every now and then there's periods of consolidation, like there were here. There was a big period of consolidation here. But right around the corner, and they're always going to be there, are these rips and dips. And this is what we do as a swing trader. We capture, especially when something's in a large gold is, for the last couple of years, year or so, moved around mostly sideways. But for the most part, we bottomed back here in December of 2016. The trend has been up. So a trend trader can focus on this. This is the bigger trend. I know I made a mess of this chart now. But swing traders, at least as a swing trader myself, I like to sidestep these sideways grinds. And this won't last forever, just like this extreme volatility in the market. That I can assure you. I don't want to get off topic too much. I'm going to wrap it up last with the VIX. This is the VIX. There's that period of extended low volatility. This is that spike in the VIX. This is just a daily chart, goes back 2 years. But we look at a weekly chart, and we can see that one thing about the only constant that I can tell you in the VIX is that it will spike. It spikes off levels, when it's low for an extended period of time. You get these spikes, but these spikes are always fleeting. You do not stay at an extended period of volatility such as we are at now. Doesn't mean we can't go higher before we go lower. I'll say that. This is the unwinding. You have to consider that. This is the unwinding of an unprecedented low, extended low period of volatility in ultra low levels. But it's going to be something along these lines. Whether we get another thrust up or not. We'll pull back. This won't be the low end of the range anymore. Most likely, we might establish a higher end of the range. Who knows? Or maybe we come back to this line, maybe somewhere here. That's yet to be seen. So let's wrap it up there, and I will post you. I will post or share a post. I'm sorry. I will share a post with you if I see any significant updates in the U.S. dollar, gold, silver, because that's one thing that we know is out of those moves of tight consolidation. It's a weekly chart of silver. Out of these periods of consolidation come the big moves. So there's a move coming. I just can't tell you right now with the highest degree of certainty whether the next move is up or down. But if we just sit tight, let the charts tell us, maybe we won't catch the exact bottom or exact top. But there's an old saying in investing and trading is the second mouse gets the cheese. So in this case, I'd rather be the second mouse than try to be the first mouse, which sometimes I am, sometimes it works, sometimes you get caught in the trap. So that's it. I hope you guys enjoyed the video, and I'll see you in the trading room.